Hi there, traders. This is Brad Gilbert with the Daily Market Insight for Friday, the 7th of July. All right, the dollar steady. Okay, we've just had a roll out of some of the preliminary or secondary jobless numbers. And although the news services or the market's been cherry picking the strong numbers, there's a bit of a little bit of a surge in some jobs. So dollar, and what that means is the dollar is sort of rallying because the prospects of, say, a second rate hike by the Fed are sort of falling into place with the data. Right. So let me just show you these numbers so you get a good idea of what we're looking at. The ADP employment change. Okay, you got ADP employment change, the jobless claims. Now, the employment change 497 versus the 228,000 consensus, right? So this is where the big led to a little bit of a spike in the dollar, although it was very short-lived, right? This isn't like highly respected in the sense of you put this number up against the non-farm payrolls, it sort of pales in significance. The jobless claims, they're sort of saying, there was a few extra people claiming. Yeah, like 3,000. Right? That's hardly anything. And then you've got the JOLTS job openings, 9.8 versus 9.9. That's a little bit soft, but there's no mention of that in the commentaries, right? So that's what I mean. The news services can cherry pick a little bit of the information to fit the story. Now, when it comes down to, actually, let's go through what's happening on the charts, and I'll come back to today's data. So, like just looking at the global markets, okay, you're seeing a bit of a flush out both sides of the market. The equity markets are very concerned, if not worried, about potential strong numbers. Strong non-farm payroll numbers means more interest rate hikes, and that'll lead to a lower equity indices, right? The dollar, on the other hand, should rally if that's the case. Now, euro, well, I know it's short term this week, it is sort of tracking a little bit lower, but overall it's still within ranges. We do have a really juicy resistance trend line on the top side here around 109, the figure. That will be a massive target, right? If those employment numbers today miss the mark, euro's got a great entry level there for a rally to the top side. Gold, well, I've left that trend line there. You can see how it sort of keeps banging through it, but overall it's tracking down. And got oil just slowly trying to make its way up through that last resistance line around $72 a barrel. And the cryptos, well, looks like they've had enough time at around 30,000. Look like they're going to drift lower. Now, if we just look at the major currencies, right, this whole dollar situation is sort of starting to bug me a bit because it's, we're not getting any consistent. What we're looking for is where's that next trend, not just a 1 month move up or down. Right, we've got this sort of weaker trend line on the downside. That's the dollar index. I'll tell you, so the dollar index, it has rallied from 102, but you know what? It's primed to basically go anywhere. And the price action around those recent releases, like even looking at the Swiss here, right, where it's been sort of hitting the ranges, that tells me the market's nervous and it's ready to go anywhere. Same here with euro. Okay, tracking up to 109. It's been down to 108.30 a couple of times. The market's very nervous there, and it's the same across the board here. If anything, Aussie just trending lower again. The Kiwi, well, it's trying to get back down there, but it's not doing as much as the Aussie. And dollar CAD, well, it's left the building and it's now heading topside. Now, the big thing that has changed and impacted, and this for those new traders new to sort of intervention sort of stuff, the jawboning, right? That's what we call it when the central banks come out and they start talking about, we don't like the rates here, we're going to intervene, we're going to do this, we're going to do that. That's jawboning, right? So, but what it's done is it's stopped dollar yen going up, and we are starting to see it track sideways with nervous moments here where it is sort of diving to the downside. Every time it does that, the market will rush in thinking, oh, this is the big one. They're going to intervene, right? Now, if I look at the bigger charts, you can see obviously the trend going up, drifting sideways, and you're starting to see it sort of drift a bit. I'd be keeping a close eye on that trend line there on the dailies. A breakdown there might see a bit of a flush out of a few more positions. And looking at the crosses, you can tell here they've done a great job jawboning once again. Okay, it's all about timing too, because I was on CAD yen and Kiwi yen previously and got stopped out. Now they're starting to go, right? It's not as easy a trade as you would think. Like, look at the price action here, say on the Kiwi, also here on, say, euro yen and sterling yen. That's hard to deal with, even almost the Aussie there, right? It is going down, but how are you supposed to know which pair which is going down against most? Well, it's oil. Oil is falling, and just check out this clean move here, the clean break there on CAD yen. But look at last week. This is where I got chopped up. You get into the trade there, and it just comes back. Unfortunately, if we had a crystal ball, we'd know exactly when the timing's on. But what I'm trying to show you here is the BOJ jawboning is taking effect, and we are starting to see the yen crosses drift down as it is with dollar yen. Right, now's the time to come back and have a look at this data, what it's going to do for us, because what it's going to do for the market, then we'll talk about what it does for us. So the market is expecting, well, they're factoring in 2 potential rate hikes here from the Fed, right? So strong numbers here. The consensus, 225. Okay, actually, let me come over here to News Score and go through the big numbers here. Because this is important overall. For the next major move, right? 225. The previous number was 339. Now, the range of the data here, very important, okay, for a more sustained move. Don't forget, the market is expecting a rate hike. So they're looking for stronger numbers. So you're looking for a number to go with the current trend, above 275. Now, below 110 really does shake the piggy bank, and we'll see the dollars evacuate, right? The other part of the equation, of course, don't forget the unemployment rate, 3.6 expected, but we are starting to see a bit of width in the range here, 3.5 to 3.8. Once again, if we want the Fed to be raising rates, you're looking for a 3.5 print and a 270, above 275 or thereabouts. These are the numbers that you're focusing on for a move topside. And if I just draw in here, if we're looking for the bottom of the range, okay, and you're looking for a higher unemployment, that'll see the dollar crash to the downside, right? So it's pretty simple, but as I'm just explaining it, you can see, well, we've got a number of different variables, and we are just really focusing on non-farm payrolls and the unemployment rate. Now, average earnings could come into play. If there's any sort of significant variance in the average earnings or a few of the other numbers here, sorry, up towards this level, then that can sort of impact the overall move. If everything is in the same alignment, like average earnings is up, the non-farm payrolls is up, and we get a weak number, which is a good number for unemployment, okay, you're going to see the dollar, they're going to start to scale in 2 interest rate hikes, maybe even a third, right? So that's the sort of, you've got so many things to think about. Now, to me, non-farm payrolls is the key number, the unemployment rate second. So 1, 2, and the last thing to consider would be the average earnings, right? We'll see what we've got. We'll see, I think, a more significant move if the numbers are weak, right? 110 is 3.8, because the market is already factoring in these hikes. So weaker numbers, you're going to see the dollar crash, and crash very hard. Volatility will be at an extreme. Now, for those traders looking for a more enjoyable day, look at the CAD and the CAD crosses, right? This is probably an easier trade, very similar to the Aussie employment numbers, right? So employment change, 20,000, the range 14.2 to 40, and the unemployment rate expected 5.3. And that's the range there, 5.1 to 5.3. So this is an easier number to deal with, right? The dollar, sure, it'll give us the big move on the dollar, but maybe trading the CAD against the crosses is an easier trade just on the face of it. Trying to trade dollar CAD can be extremely hazardous, as you'd expect, with Canadian numbers coming out and the US. It could be all over the shop. All right. So that's where we are. Like, the CPI numbers are more important and an easier number to trade. If you are looking for this, make sure you control your risk. If you're going in with pending orders, I'd be looking at entry levels 15 points either side of the market, okay, to give yourself some room. Avoid the volatility before these releases, and we'll see how it rolls out from here. All right, guys, and last but not least, factor in the number coming out as expected, right? It'll save you losing your mind, a bit of performance anxiety, so focus on these numbers. If they do come out as expected, don't start to think that something amazing is going to happen, because it won't. It'll completely diffuse itself. All right, guys, have a good one. All the best. Cheerio.